All right, today we're going to play doctor, but for a company, we're going to give it a complete financial checkup, looking past the obvious numbers to figure out what's really going on under the hood. And our main tool for this, something called ratio analysis. Let's get right into it.
So, how can you tell if a business is actually healthy? I mean, it seems like a straightforward question, right? But it's not as simple as it looks. A company with massive sales might look great on the surface, but that doesn't always mean it's successful. To get the real story, you've got to dig a little deeper, kind of like a doctor running some tests on a patient. If you've ever opened up a company's financial statement, it can feel like you're just staring at a giant wall of numbers. And yeah, those numbers are important, but by themselves, they don't really tell you much. They don't tell you the story of how that company is performing or what dangers might be lurking around the corner. And that is exactly where financial ratios come in to save the day. See, a ratio is a pretty simple idea. It just takes two numbers from those financial statements and compares them to each other. But that simple act is incredibly powerful. It turns all that raw, confusing data into a real insight, something we can actually use to analyze a company's health. Honestly, the best way to think about ratios is to go back to that doctor's checkup analogy. Ratios are literally the vital signs for a business. We're about to check its pulse, take its blood pressure, and a whole lot more, but for its finances. Today, we're going to look at 4 key sets of these vital signs. First up in our financial checkup, liquidity ratios. This is where we check the company's pulse, to see how it's holding up in the here and now. The very first question any good doctor, or in our case, a financial analyst, is going to ask is this: is the patient stable right now? For a business, that translates to something really basic. Can it pay its immediate bills? We're talking about things like payroll for its employees, the monthly rent, and paying its suppliers on time. And that ability to handle all its short-term bills, well, that's what we call liquidity. It's all about having enough cash on hand, or things that can be turned into cash quickly, to deal with whatever debts are coming due soon. Let me tell you, without good liquidity, even a really profitable company can find itself in a world of trouble. So here's the quick summary on liquidity. It's all about short-term survival. The comparison to checking your own bank account before the rent is due, that's perfect. This ratio answers one simple, absolutely critical question. Are we okay right now? Okay, so we've established that the patient is stable. Now it's time to run our next test, activity ratios. This one is all about measuring just how efficient the company is. All right, once we know the company can survive day to day, we want to know how well it's actually running. Is it making the most of everything it has? This is kind of like checking a patient's metabolism. Are they using their energy effectively, or is it going to waste? These ratios show us how well a company is using its assets, its stuff. For instance, how quickly is all that inventory on the shelves actually selling? How much money is it making from its equipment and its buildings? Strong activity ratios tell you the business is humming along like a well-oiled machine. So in a nutshell, activity ratios are our efficiency meter. They show you just how fast the company is turning its assets into actual sales or cold hard cash. Fundamentally, they answer the question, are we being smart with the stuff we own? All right, time for our third vital sign check, leverage ratios. We know the company can survive the short term, and it's running efficiently, but now we need to look at its long-term risk. Now, this is a huge question. See, debt can be an amazing tool for growth. It lets a company expand way faster than it could on its own. But it's also a major source of risk. Too much debt can become a crushing weight that's impossible to escape. So that's exactly what leverage ratios do. They show us just how much a company is relying on borrowed money. They compare what the company owes to what it actually owns free and clear. It's a constant balancing act between risk and reward. So the key takeaway here is that leverage ratios are our long-term risk meter. They give us a really clear picture of what the company owes versus what it owns, and they give us a sharp answer to that all-important question. Just how risky is our financial setup? And now for the grand finale of our checkup, the one everybody always asks about, profitability ratios. This is usually the first thing people think of when they wonder if a business is doing well. I mean, this is the bottom line, isn't it? After all the bills are paid, all the salaries, all the expenses, is the company actually making any money from its business? For any company, this is pretty much the ultimate measure of success. And figuring this out can be really simple. Just look at this example. Say a company has net sales of 25 lakh. After all its expenses, it's left with a net profit of 10 lakh. You just divide that profit by the sales and bam, you get a profit ratio of 40%. That one number tells you so much. It means for every 100 rupees in sales, this company gets to keep 40 as pure profit. That's a powerful metric.
So when it comes down to it, profitability ratios are the final scorecard. They tell us if a company can actually turn its sales and all its assets into real earnings. They answer that final critical question, is this whole thing actually working?
So after running all these tests, what's the diagnosis? Well, we've seen that ratios are incredible diagnostic tools. Just like a blood test can show a vitamin deficiency, these financial ratios help us pinpoint exactly where a company is strong and where it might be a little weak.
But here is probably the most important takeaway of all. A doctor would never make a diagnosis based on a single vital sign, and neither should you. A high temperature alone doesn't tell you what the illness is. You have to look at everything together, the liquidity, the activity, the leverage, and the profitability, to get the full, accurate picture of a company's health.
And that leaves me with one final thought for you to chew on. Imagine you find a company that's incredibly profitable. I mean, its profit ratio is off the charts, but its liquidity is terrible. It can't even pay its bills next week. Is that really a safe, healthy investment? Think about it. That's the kind of critical thinking that ratio analysis gives you the power to do.